Hello, everyone. My team and myself here today are to present our analysis on Hilton Worldwide Holdings Inc. and also draw an investment recommendation on our M&A transaction of the company. So who are we? We are JVRG Consultant. Our partner Vincent has over 25 years of experience in the M&A transaction, and we also have our principal grant, project leader Rushi, and myself Gia here to present. So a general overview of the company. Hilton Worldwide Holdings Inc. was founded in 1919 and the headquarters is in Tyson Corner, Virginia, United States. Hilton has been a leading global hospitality company over 100 years. And the CEO, Christopher Natasetta, who has served as the president and CEO of the Hilton Worldwide since 2007. The revenue is about 4.3 billion, and it has over 6,000 properties over 118 countries. On behalf of the Marriott management, we helped and performed a detailed analysis on Hilton. And in conclusion, we do not recommend buying Hilton at present for an investment opportunity as of now. From the previous discussion we had, we learned that Marriott wanted to become the biggest corporation in the industry. So as your strongest competitor, Hilton has a current market value trading price of $116, which just seems appealing. So you might think this is a good buying opportunity, but we will walk you through our financial due diligence and show you our analysis result. So next, Grant will kick us off and talk about analysis from the industry aspect.
Thanks, Jia. First, let's take a look at hotel industry analysis. As the largest player in the industry, Marriott takes more than 16% of market share, while Hilton only takes less than 7%. So for the macroeconomic environment, the COVID-19 pandemic has hit the hotel industry hard during the past 2 years. However, the industry has been recovering since the post-pandemic period, and the future profitability has a potential to increase. And currently, Marriott owns 8,000 plus properties with 30 brands across 139 countries and has more than 120 million loyalty members. The company recently has also received the highest guest satisfaction rating in luxury and upscale hotel segments. Despite its rapid expansion, Marriott still faces challenges among the intense market competition, especially in global emerging market. Although the company has been expanding rapidly through the horizontal acquisition, such as opening more than 100 hotels in Asia Pacific this year alone, Marriott's hotel locations is still unevenly distributed between the domestic and international market by 70% to 30%, which has become a major risk in the competition. And next, let's take a look at Hilton's SWOT analysis. Like Marriott, Hilton has a strong brand recognition, especially in mid-scale hotel segment. It has more than 6,000 hotels with 18 brands in 5 market segments, which provides diversified services with heavy tech integration and customization. However, Hilton also has some weaknesses that relies heavily on debt and has suffered from losses in recent years, even before the pandemic. Like Marriott, Hilton is also heavily focusing on the domestic market, with more than 78% of its property within the US. This shows that acquiring Hilton will not solve Marriott's problem of its relatively low international presence. It also brings the opportunity of international expansion as a potential growth point for Hilton. Besides, Hilton also has the opportunities such as forming strategic alliances with other industries like airlines or car rental companies, and further enhancing the strength in mid-level budget hotel sector. Hilton faces threats from the long-term impacts of the COVID-19 pandemic, such as short of labors and the trend of work from home that decreases business travels. Another threat will be the political instability in some markets, such as Russian sanctions due to its war in Ukraine and China's zero-COVID policy that periodically locking down its major cities. Hilton also faces franchisee management risks. The company has fined some of its franchisees in China due to poor services and hygiene standards. Now, let's hand it over to Rushi to go through the financial analysis.
Thanks, Grant. So we've talked a lot about Hilton as a company. I wanted to talk to you about the numbers behind Hilton and tell you the financial story of why we deemed it as an overall bad acquisition. Taking a look at its WACC, we calculated it to be 5.73%. Why is this so low? Well, taking a look at Hilton's balance sheet for fiscal year of 2021, we see that their total liabilities has exceeded their assets, resulting in a negative retained earnings and negative shareholders' equity for the year. Furthermore, when calculating for Marriott's WACC, we find it to be 9.54%. Comparing that against Hilton's expected market return rate of 5.84%, we see that this merger would be destroying the wealth of Marriott by 3.70%. As for every $1 Marriott invests into Hilton, we lose about 3.7 cents of wealth. The WACCs for both companies were calculated using the capital asset pricing model, assuming a 5-year treasury risk-free rate and beta values shown in the Excel figures. However, this isn't just one metric we used to decide if this merger was a bad idea or a good idea. We also calculated the intrinsic value of Hilton using the discount model method to see if the company is currently overvalued or undervalued. We looked at Hilton's historical data for the last 5 years and used it to forecast cash flows through 2027 and use those values to estimate a terminal value for future cash flows. Combining it with Hilton's WACC of 5.73%, we get a total enterprise value to be $24.66 billion and a price of $87.46 per share of Hilton, which is much lower than Hilton's current trading price of $116.34, making Hilton extremely overvalued. But why is the market overvaluing Hilton? Could this be due to a lot of different factors that are out of our reach? Well, one major factor is the pandemic. As we are still dealing with the effects of the aftermath of COVID-19, we see that the hotel business was one of the industries that took one of the biggest hits due to health and public safety risks. Due to high volumes of people no longer needing to travel for business or personal reasons, revenues was not as high for fiscal years. As we are slowly recovering out of the pandemic and people are resuming traditional traveling methods, we see that Hilton in 2021 ended up with a very high P to E ratio, which could mean investors are expecting a high growth rate in the future. And this is why we see an overvaluation of the stock. We can also see from our revenue graph that while revenues haven't bounced back to pre-2020 or COVID numbers, the year-over-year quarterly growth has been positive, making it seem as if Hilton is gaining back more and more of its business, which could also result in a high overvaluation. However, we didn't just stop there. We also decided to factor in a market valuation approach to confirm our conclusion that Hilton is overvalued. We decided to compare Hilton against its major competitors such as Hyatt, Lowe's, IGH, Wyndham, MGM Grand, and the host hotels. Looking at their financial data from 2021, we decided to evaluate Hilton based on 3 market multiples: enterprise value over revenue, enterprise value over EBITDA, and enterprise value over EBIT. Taking the median of all 3 multiples and weighting them, with the highest weight being on the enterprise value over revenue multiple, as it is most commonly used, since it has a comprehensive alternative to equity market capitalization and includes debt. This model also confirmed our earlier valuation of Hilton as it being overvalued and recommend not to acquire, as the market approach also showed Hilton to be only worth $83.55 a share compared to its current market value of $116.34. Now I will pass it over to our partner Vince, who will go over financing methods and synergy ideas if this merger with Hilton is worth taking the risk.
Thanks, Rishi. Now, Marriott, the buyer of this acquisition, has a stock price of $143.35 in 2022. There are 329 million shares outstanding with a 5.95 EPS. Analysts anticipate about a 20% growth with 738 EPS expected for 2023, resulting in 887 for 2024. Now, the target company, Hilton, has a 116.34 stock price with 281 million shares outstanding, and with a 0.15 dividends per share and an expected 38% EPS growth rate with 61% dividend growth rate, the respective EPS for each year are 408, 566, and 785. Marriott has $12 billion in OPEX. Hilton has $4.8 billion. There's a 20% premium estimate with a government-regulated 21% tax rate for new companies. And with these inputs, we ran a combination analysis with a sensitivity analysis for various premiums from 10 to 30%. This resulted in proposing funding the acquisition with 80% debt and 20% equity. The combination analysis shown here shows positive EPS in 2023 for all premiums and positive EPS for all premiums in 2024. This suggests there's a strong potential for positive net present value in year 2, with goals to stick with any premium paid. This cuts down on the debt capitalization and may maintain the existing credit rating. With these added costs, savings, and profit boosts, they do expect to see many charges initially, gradually realizing the increase in operating income over time. Of the $3.3 billion aggregate charges they anticipate, $2.4 billion are expected in 2023, followed by the rest in 2024. With roughly 10% of existing customers delaying hotel visits, there would also be a reduction of $122 million in customer attrition in 2023. But however, due to the cost-cutting, consolidation, new services, and more, the operating profit is expected to increase by $2.4 billion per year, with a gradual increase over time. Assuming a linear increase over the 3 years, we expect to see $800 million in 2023, $1.6 billion in 2024, and then $2.4 billion in 2025, and so on. Using the income approach and changes to operating income over time, this adjusts our equity value per share to be $97.13. For the analysis, we used the growth rate of the 10-year risk-free rate of 2.96%. Some analysts even use no growth rates for synergy analysis, so our sensitivity analysis spans from 0% growth rate to the 10-year risk-free rate of 2.96%. We also use the 5.73% WACC, but have outer bounds of about plus or minus 1% to show upper and lower bounds that way. We do not really see an increase in the equity value unless the growth rate is high and the WACC is low, as shown from the sensitivity analysis here on this slide. Now, I will now pass it to our consultant, Gia, to look at due diligence and more.
After all the analysis, I believe we have a clear understanding on the estimated impact of the M&A transaction. So here, there are some additional questions for due diligence purposes. And a few I wanted to highlight is we need to think about what are the laws, regulations that apply to the company and industry, and what capital expenditures does Hilton plan to make in the near future? What are companies' current and future strategy? And also we need to think about the COVID impact of Hilton's financial performance. So today there's a window of opportunity. Organizations must navigate the greatest financial and challenges of our time. M&A transactions are among the most complex life events your enterprise will undertake, and no two deals are alike. Our M&A leaders reach into a cross-functional pool of more than 20,000 M&A practitioners in key locations around the world to assemble a handpicked team. We advise corporate buyers throughout the entire M&A transaction, and we really help to define the right strategy, realize your goal, and identify future opportunities for your enterprise. So I hope our presentation today provided a clear view of your company, and I look forward to working with you again in the near future. Thank you so much for attending our presentation today.